Hello and welcome to Currency Exchange. For myself, Eimear Daly, and NatWest's team of FX market strategists help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today, I am joined by our two co-heads of G10 FX strategy. We've got Brian Daingerfield, who's joining us from the US, and Paul Robson, who's based here in London. Well, what a difference a week makes. For months, FX markets and markets generally have been fixated on inflation dynamics, the risk that economic growth was just too strong to see inflation return to target. But last week, a new risk emerged, the risk of financial stability from much higher global interest rates. This transition from the US over to Europe and really ricocheted across global asset prices. Brian, I've got to come to you first because we really saw a dramatic repricing in market expectations for the Federal Reserve. And I do think dramatic kind of underplays the price action we saw. Obviously, the FOMC is the next big risk event on our calendar. Do you think that repricing is justified given these financial stability risks? And what are you thinking about the dollar outlook from here?
Thanks, Eimear. Yeah, it has been a very significant repricing in expectations, not just for the Federal Reserve, but across central banks that we've seen. The 2-year Treasury yield over the past 7 days has rallied over 100 basis points from its peak levels just a week ago after some of the stronger data and the Fed signaling. If you remember last week, it was only last week that Fed Chair Powell said that if the totality of the data merited it, that the Fed could consider speeding up the pace of interest rate hikes. Perhaps the biggest change that we have seen is that the totality of the data now includes financial stability. So you think about the Fed's its dual mandate, its growth and inflation mandates. Now we have sort of a return of that shadow mandate, that third mandate for financial stability. And so we think that the risk reward now favors the Fed doing less rather than more. We actually think the Fed's likely to pause its tightening cycle at its meeting on March 22nd, effectively to take a bit of a lay of the land, and that the risk reward here maybe favors dealing with the potential issues in the immediate term and putting the inflation fight, which is a more medium-term consideration, not necessarily to the back burner, but allowing there to at least be a pause for breath here as you accumulate more data, learn a little bit more about the potential contagion risks and potential issues facing financial markets. I think, and we'll talk about the ECB in a second, or at least Paul will discuss the ECB in a moment, though we did just have the ECB decision this morning, and that does make you wonder after they hiked their policy rate as anticipated, as previously signaled, whether the Fed would consider taking a similar track. But we do think that the risk reward does favor them taking a pause here. And like you said, Eimear, this is a very significant change in the way we think about from the dollar perspective, how we think about the data in relation to the dollar. We've spent the last month and a half talking a lot about data dependence. It's all about the data. Even in last week on the podcast, we were talking all about how the CPI and the NFP were going to be make or break for the Fed for its meeting in late March. Suddenly the data in the near term does not look as important as we face these near-term challenges coming from financial markets. And so from that perspective, I think it's a very big change in the way that we think about the way the dollar responds to incoming indicators on the economy. So you think about the potential ramifications from tighter financial conditions for consumer and business confidence, for credit accumulation and the like. There's a potential here that the market starts to price towards weaker growth expectations, disinflationary pressures that can result from financial market instability, and continues to price out the Fed further from here. And so from a dollar perspective, one of the big changes from our side is that maybe we're moving away from this data dependence mode where the data had been very strong in the US, continues to be fairly strong in the US, pushing the dollar stronger for the duration of the last month and a half. Now maybe we're moving away from that towards something a little bit less data dependent.
Yeah, I completely agree. I do think, data is always kind of intrinsically backward looking. And almost what we're seeing now in financial markets could actually be the biggest drivers of dollar direction and of Fed policy. I know you've spoken previously about this kind of idea of moving from rate divergence to rate convergence. Could you dig into this a little bit more?
Yeah, absolutely. So again, if you think back over the last month and a half, the big theme in financial markets was the market pricing and favoring currencies where central banks had been delivering hawkish messaging and fading those that appeared to be lagging behind, especially in economies where the data supported the hawkish discussion points and the hawkish leaning of the central bank. So you think about the Fed on the extreme of one side of that, where the data had been very strong and the market had been repricing the Fed. We had been cautious and remained cautious about whether or not that move is a last hurrah of hawkishness from the Fed. But the market was, very focused on interest rates, relative policy as a big driver, and was really sort of drowning out a lot of other potential factors that could be driving the currency. On the flip side, you have economies and current central banks who've taken on a more dovish tact. The Bank of Canada with its interest rate pause, for example, and maybe the extreme example here being the Bank of Japan with its yield curve control policy, ultra dovish policy. And so for the last couple of months, we've been looking at interest rate divergence in favor of the dollar and hawkish central banks as the big driver of markets. Now we seem to be seeing the opposite, where markets are rapidly pricing out tightening in the areas in which they had been priced in. So from that perspective, we have a bit of rate convergence that the yen, understandably, is one of the big potential beneficiaries of this type of move, because its rates are very low and are effectively anchored by yield curve control policy. Interest rate divergence is almost entirely a factor of what's happening outside of their borders rather than inside of their borders because of that policy. And so from that perspective, we've suddenly flipped away from rate divergence as the big theme in FX markets to suddenly rate convergence as we priced out a significant amount of tightening over the last couple of months. And so that, I think, is, also when we think about the dollar, lower data dependence as we've priced out quite a bit of Fed, that's, removing some support for the dollar here on net.
Yeah, and on that note, we just had that ECB decision, and markets significantly reduced expectations of how much the ECB was going to hike by. A lot of people were saying they were going to stay on hold, even though they pre-committed to 50 basis points. While full overnight, they did hike by 50 basis points. But the euro dollar reaction was a little lackluster. How are you reading this hike, and how do you think markets are interpreting it?
I think that's exactly right. The euro was marked a little bit lower. We had a bigger reaction in bond markets. Maybe bond markets were a little bit more worried about the outlook for policy, or maybe a little bit of a hint of this is a policy mistake given financial market volatility that we've seen over the last 10 days or so. I actually think delivering a 50 basis points is positive for the currency. Obviously, it was a very difficult meeting for the ECB to work around, given that they were first up. The Bank of England, for example, has got a little bit more time to assess the impact on the outlook of recent volatility in markets. And why do I think that? Well, I think that it's more about what worries markets more. Is it about the read across to financial market stability, or is it about growth risks and policy mistake risks? And I would say, given how the currency has been reacting to recent developments, I would say it was more about financial stability risks. And so this decision to raise rates 50 basis points, I think, is a sign of confidence in the outlook for financial stability within the region. Now, of course, it could be a confidence trick, but they have all the information. They have far more information than I do. And the fact that they are confident enough that they can continue to raise rates, and that they have tools to help markets, lubricate markets, to make sure that they work correctly, I think is a positive. So it's very interesting what Brian was saying about monetary policy convergence. And obviously the story has been one of ever higher US rates. And it feels like the impact on credit conditions, for example, is going to be more severe in the US than it is in Europe. And ultimately that plays higher euro dollar. And so we still hold to the view that euro dollar is ultimately heading up to 115. And I'm actually more confident in that call than I was just a couple of weeks ago.
And kind of one part of the world which actually wasn't causing that much volatility was the UK. We had the UK budget. which went up kind of without a hitch compared to last October. I just have to draw you on it. Did you see that much impact for long-term sterling directing? Do you think it's a positive that it didn't have much impact on sterling on the announcement?
Yeah, as you say, it sort of almost passed without notice, which is, I think, important in itself. Even for the bond market, you wouldn't know that we actually had a budget, and given some of the turmoil we've had in bond markets over the last sort of 6 months, I think that that's important. Of course, the government didn't really have much wiggle room in terms of policy, and probably a little bit emotionally scarred from some of the volatility. So it was about the slow move to normality for the UK. So there wasn't a lot in it for the currency. But I think that there's two important points to note. So the first one is the optics around that. So the fact that the UK delivered a budget that didn't move markets compared to the last update back in the autumn that saw sterling extremely weak and bond markets extremely weak. The fact that it was delivered without much market impact, I think, is a positive. And it was also delivered at a time when you had financial market stability concerns. And sterling actually rallied. It almost had an air of a sort of island of stability, almost a pun there, but in this sort of world of financial market instability, which compared to where we were 6 months ago, I think is a remarkable transition, which I think is supportive of the currency. The second point I would make is just the sort of using Powell's term, the totality of the budget. And as I said, it didn't have a lot of wiggle room, but what were they focusing on? Well, the government was focusing on investment and on the labour market. And when you think about, what drives economic growth over the medium term, it's a relatively simple structure. It's basically how much investment, the capital stock there is, how much you work that, and the size of the labour market. And this was a budget delivered to try and increase the labour supply and get people investing. And for that, for the longer term, that should be a positive for growth. Now, whether they've done enough, whether it has the impact that they want, remains to be seen. But why is that important now? Well, as we just discussed last week about how sterling was being penalised, we had sort of entrenched pessimism around the UK. It was about weak growth expectations. It was about the collateral damage on growth of the central bank's attempts to get inflation down, which was holding sterling back. So anything that moves the needle on growth expectations should be supportive of the currency. Now, for now, the data are just sort of challenging that pessimistic or bearishness in markets about growth, and we think that that's a go with. So we still hold to our higher sterling versus the dollar view, just as we hold the same view as euro dollar ultimately heads higher.
Well, Eimear, if I could jump back in, I'd love to ask you about emerging markets as well. I think in emerging markets, we tend to default to emerging markets as an asset class being either all one way or all the other way, where you have periods of relative calm in financial markets or potentially generally positive for emerging market currencies, and periods of financial market instability and stress are generally negative for emerging markets. But one of the things I know that you and your team have been discussing is differentiation among individual economies, trying to look at emerging markets a little bit less from this all one trade style thinking, and instead look for economies with strong fundamentals and potentially high carry versus otherwise. Is that a view that you still hold on to? How are you thinking about emerging market currencies, both as a whole and from an individual economy perspective, through some of this instability that we've seen?
Yeah, I do think in kind of times of instability, or when broad dollar direction is kind of in flux or not exactly clear, you have to kind of play relative value. So you got to play EM versus EM. So we're definitely looking at those bottom up stories and seeing which is the strongest. I think, especially in an environment where it seems quite risk off, there's kind of financial stability concerns, it's good to kind of double down into kind of domestic idiosyncratic stories where there's kind of a negative element to it. So one of the ones, we've been really highlighting, we think there is big risk, is South Africa, where we've had unprecedented electricity rationing I think we've known, for the last decade probably that, South Africa, is very much dependent on the state electricity grid, and it just doesn't generate enough electricity to meet demand. But in December, we had unprecedented load shedding, where effectively the monthly amount basically surpassed all previous annual totals. And that's kind of reinforced by kind of more difficult diplomatic situation. South Africa seems to be shifting into alliance with China and with Russia. And also concerns were raised over corruption, its corruption policies. And then probably the counter side to that is Brazil, where actually, we think a lot of those political concerns and worries are actually starting to resolve themselves. And it's supported by very strong carries to just holding this currency. You earn a very solid return. So I think kind of focusing down on those fundamentals is probably a way to kind of protect yourself to kind of a global investment environment, which is still very much in flux. But guys, on that note, I will have to wrap it up. And thank you for joining us this week. We'll see what next week brings. And thank you to my two guests as well. If you do like the podcast, please click like and also remember to subscribe so you can get the latest edition first. Thanks again.